Saturday, November 22, 2025, a day that will be etched in financial history as one of the most devastating Black Saturdays. No warning, no shelter. In less than 24 hours, over $500 billion in market capitalization evaporated from the cryptocurrency market. Bitcoin, the uncrowned king, surrendered the $100 fortress. Ethereum collapsed before the $3 mark. Millions of investment accounts are drowning in red. Billions of dollars in long positions were liquidated in a whirlwind of panic. Welcome back. I am Thien. What we are witnessing is not a normal correction. This is not a simple, buy the dip, opportunity. This is a structural shift. A systemic collapse. Many are asking, why? Why now, when everything seems so promising in October? In today's deep dive analysis, we won't just look at the numbers. We will dissect this storm. We will dive deep into the macro layer of the global economy, plunge into the microstructure of the derivatives market, and trace the on-chain footprints of the whales who activated the destruct button. Fasten your seatbelts. This is the naked truth about the crypto deluge of November 2025. To understand the brutality of today, we must rewind just a few weeks. October 2025, the legendary Uptober. Bitcoin shattered its all-time high, surpassing $120. Market sentiment was at extreme greed. Analysts were racing to project price targets of $150,000, $200,000 by year-end. The narrative of a supercycle was spreading everywhere. Spot Bitcoin ETFs were absorbing billions of dollars in net inflows every week. Everyone believed that this time would be different. But beneath the surface of that euphoria, cracks began to appear. In early November, we felt the first tremors when rumors of US-China trade tensions ignited. The market dropped but quickly recovered. That rapid recovery created a dangerous psychological trap: complacency. Investors believed all bad news was priced in, and that any dip was just an opportunity to buy more. They were wrong. They underestimated the macro tsunami forming on the horizon. The root cause of this crash does not lie within the crypto market. It comes from Washington and Beijing. It comes from the US Federal Reserve. We are taking a double punch from the macro environment. First, Trade War 2.0. By the middle of this week, what the market thought was just a negotiation bluff became reality. The US confirmed 100% tariffs on a range of strategic goods from China, effective December 1st. This is no joke. This is a direct shock to the global supply chain. Shipping costs are skyrocketing. Raw material prices are spiking vertically. What does this mean? Cost-push inflation is returning. And that leads us to the second, more devastating punch: the Fed's betrayal. All year long, the market priced in a soft landing scenario. The belief was that inflation was under control and the Fed would begin cutting rates in December to support the economy. That is why risk assets like tech stocks and crypto flew high. But this week's economic data tore that script apart. Inflation is proving stickier than expected. And with the new tariff shock, there is no way the Fed can cut rates. Market expectations flipped 180 degrees. From cutting soon to higher for longer. Even some pessimistic economists have started discussing the possibility of another rate hike in early 2026. The inevitable consequence is this. Look at the DXY. The US dollar is crushing everything. When the world is unstable, when US rates are high, global capital has only one place to go: back to the US. Sheltering in dollars and treasuries. Crypto, the riskiest of risk assets, is the first victim of capital withdrawal. That is why we see ETF flows reversing, and selling pressure appearing across the board. But macro was just the spark. To create an explosion like last Saturday, we needed a powder keg. And that powder keg lies right within the structure of the crypto market. If macro is the fire, market structure is the gasoline depot. And this depot has been pumped full to the point of bursting for the last 2 weeks. Look at this metric. Open interest, OI, the total value of open derivative contracts. Before the fateful Saturday, Bitcoin's OI reached an all-time high. But what's scary isn't the number, but its nature. The majority of these orders were long positions utilizing extremely high leverage. In the euphoria of October, Traders became greedy. They didn't just buy Bitcoin with the money they had, spot. They borrowed money to gamble. They used $1 of capital to control 50, even $100 of profit. They believed the $100 mark was an unbreakable steel wall. They placed stop-loss orders right below this level, and that excessive confidence set the stage for tragedy. They unintentionally turned themselves into fuel for the fire. And here is the second fatal factor. The factor determining the depth of the crash: timing. Why Saturday? Why not Wednesday or Thursday? In traditional finance, weekends are for rest. Banks close. Hedge funds and market makers, the giants, who play the role of providing liquidity and stabilizing prices, pull the plug. The crypto market never sleeps. But its liquidity does. On weekends, the price buffer becomes thinnest. Imagine you are driving. On weekdays, the road has solid guardrails. If you lose control, you hit the rail and stop. But on Saturday, the guardrails are removed. When liquidity is thin, a large sell order can push the price very far. A 1% fluctuation on a weekday can become 5% on a weekend. In the early hours of Saturday, November 22nd, when the bad macro news hit, the buyers of last resort were not there. The playground was left to algorithmic bots and the panic of the crowd. And when the spark, macro news, meets the gasoline, high leverage, in a room with no exit, thin liquidity, we get a long squeeze, a liquidation vortex. Let me explain this mechanism simply. It is like the snowball effect. Phase 1. The slight nudge. Due to the tariff news, some whales decided to sell early to defend their portfolios. Bitcoin price dropped slightly from 108.000 to 105.000. This is the first snowball. Phase 2. Chain reaction. The 105.000 price level hit the liquidation points of the most reckless players, 100x leverage. The exchange is forced to sell their assets immediately at market price to recover capital. This forced selling pushes the price deeper, piercing 102.000. Phase 3. The avalanche. At 102.000, it triggers the stop losses of the mid-leverage group, 50x. 20x. The sell volume is no longer a few $1 million, but hundreds of millions. Massive selling pours into the thin liquidity of Saturday. There are no counter buyers. Price goes into freefall. Phase 4. Mechanical panic. When the psychological $100 mark broke, the panic was no longer emotional. It became mechanical. Algorithmic trading bots automatically triggered sell-offs. Dealers sold to hedge. Retail investors woke up to see their accounts halved and sold in desperation. This is a deadly feedback loop. Price drops $, right arrow $, liquidation $, right arrow $, sell-off $, right arrow $, price drops deeper $, right arrow $, more liquidation. It doesn't stop until all excess leverage is swept out of the market. In this crash, the system did not distinguish between good projects and bad projects. Bitcoin, Ethereum, Solana, all were sold off equally to cover liquidity. That is why we call this a systemic liquidation event. The result? $2.5 billion evaporated. A brutal reset, taking the market back to the starting line. Those using leverage were wiped out. The market is now lighter, but also full of wounds. But was this collapse predictable? Were there footprints on the blockchain that we missed? The answer is yes, and it lies right in the on-chain data that we will analyze right now. In traditional finance, money flow is a secret. You never know when Warren Buffett sells a stock until the quarterly report is published. But in crypto, we have a ruthless advantage: absolute transparency. The blockchain is an eternal ledger. It records every emotion, every decision, and most importantly, every betrayal. Many say this crash was a surprise. But on-chain data says, no. The giant's footprints were imprinted in the sand 48 hours before the tragedy occurred. Let's do some forensics on this case. Look at this. This is the exchange net inflow chart. 2 days before the tariff news exploded, while Telegram groups were still chanting "to the moon," while retail was busy debating if Bitcoin would hit 150K or 200K. Something unusual happened. Tens of thousands of Bitcoin were quietly transferred from cold wallets, usually used for long-term storage, to the hot wallets of Binance, Coinbase, and OKX. Why did whales move money to exchanges? They didn't move it there to look at it. They moved it there to sell. This is classic behavior of smart money. They have better information. They have higher macro sensitivity. They smelled the gunpowder from Washington. And they acted decisively. Distribution. Who did they sell to? To the retail investors who were excitedly buying in at $115. The naive ones who believed the uptrend was eternal. Whales took profits right on the heads of the crowd. If whales were the early sellers, who were the late sellers? Who created that miserable long shadow down to the $90 zone? It was the short-term holders, STH. People who bought coins within the last 1 to 3 months. Look at the SOPR indicator. When this line is above 1.0, investors are selling at a profit. But look at November 22. It crashed brutally below 1.0. This means, the vast majority of those selling in the last 24 hours are selling at a loss. This is the textbook definition of capitulation. The behavioral difference here is painful. Whales sell at high prices to realize massive profits. Retail buy that supply at the top, hold losses in fear, and finally sell off at the exact bottom because they cannot withstand the psychological pressure. On-chain data shows a massive transfer of wealth from weak hands to strong hands, waiting in the lower price zones. Leaving chain data, let's look at the naked reality on the price chart. For technical analysts, yesterday wasn't just about losing money. It was a broken structure. The $100 mark. It wasn't just a round number. It was a psychological fortress. All through October, the bulls defended this mark with their lives. But yesterday, it was pierced like thin paper with massive volume. Rule number 1 of technical analysis: support, when broken, becomes resistance. Now, $100 will become a reinforced concrete wall blocking any recovery attempts. Millions of people trapped above this level will be waiting for the price to recover just to sell at break-even, creating massive supply pressure. Worse, Bitcoin closed the daily candle below the 50-day moving average, MA50, the indicator of the medium-term trend. The last time this happened, it took us 3 months to recover. And look down below, the final seawall, the MA200 line at the $88-$90 zone. If the bears push the price through this zone as well, then we are no longer talking about a correction. We will officially enter a crypto winter. The only glimmer of hope, the RSI indicator, is in extreme oversold territory. Usually, this signals a dead cat bounce. But be careful, in a strong downtrend, RSI can stay at the bottom for weeks. Don't try to catch a falling knife when the blade is falling at this speed. What did the storm leave behind? Not just accounts cut in half or divided by 3. It left a deeply wounded ecosystem. We lost $500 billion in capitalization. But the scarier number lies in DeFi, decentralized finance. As collateral assets like ETH and SOL drop 20 to 30%. A series of blockchain loans are facing the risk of cascading liquidation. If prices drop another 5 to 10%, we will see a real liquidity crisis on lending protocols. Bad debt will appear. And don't forget the miners. With Bitcoin dropping to the low 90s, their revenue has dropped sharply while mining difficulty remains high. Small mining farms using old machines are starting to lose money. If they are forced to sell their Bitcoin reserves to pay electricity bills, that will be the next source of sell-off supply weighing on the market. Now for the million-dollar question. Where do we go from here? Don't listen to anyone who says with 100% certainty that prices will go up or down. In investing, we don't guess. We build scenarios and assign probabilities to them. Based on current macro and technical data, here are the 2 most likely scenarios for the final weeks of 2025. The bear scenario, and unfortunately, this is the higher probability scenario right now, 60%. Trigger conditions. Trade war escalates. China retaliates against U.S. tariffs. Supply chains truly clog. Hawkish Fed. November inflation data worsens. Fed confirms high rates through 2026. DXY continues to break the 110 peak. Progression. In this scenario, Bitcoin will not be able to reclaim the $100 mark. It will have a weak recovery, dead cat bounce, to the 95K-98K zone and then be sold off. Next target. Retesting the MA200 line, $88-$90 USD. If 88K breaks, we will see Bitcoin return to the $70 zone. Altcoins will divide another 30 to 50% from current prices. The market will go into a hibernation state lasting at least 6 months. The bull scenario. Probability 40%. This is the ray of hope for the bulls. Trigger conditions. To make this happen, we need a macro miracle. The Powell put. If the US stock market also crashes hard alongside crypto, the Fed may be forced to pivot, signaling easing to save the economy. Trade cooling. Tariff news turns out to be just leverage for negotiation and both sides reach a temporary truce. Progression. Yesterday's crash was a giant bear trap to shake out the last weak players. Whales return to accumulate aggressively at the $90 zone. Bitcoin must reclaim the $100 mark decisively within the next 72 hours. If it does this, we will see the price return to the old peak in December. Whichever scenario happens, your task is not to predict correctly, but to survive. Here are 3 golden rules for you to weather this storm. Cash is king. Don't try to catch a falling knife when the market is panicking. Don't rush to dollar cost average (DCA) when the bottom isn't visible. Holding cash, USDT, USDC, right now is an investment position. It gives you a steady mindset and ammunition to buy when the market truly bottoms, possibly at the MA200 zone. No revenge trading. I know many of you just lost a lot of money. The feeling of wanting to win it back, wanting to use high leverage, X50, X100, to recover what was lost is very strong. Stop. That is the fastest way to lose the rest of your money. Turn off the computer. Go for a walk. Leave the market for a few days. Don't trade in anger. Rebalance. If the bear scenario happens, altcoins will die very fast. Consider converting your portfolio from junk coins and weak ecosystem coins to Bitcoin or Ethereum. In winter, only the kings survive. Ladies and gentlemen, the financial market is a place that transfers money from the impatient to the patient. Today's crash is very painful, but it is an inevitable part of the game. It eliminates excess, punishes insatiable greed, and teaches us expensive lessons about risk management. Winter may be approaching, but spring will surely come. Those who remain standing through this storm, those who keep a cool head and their capital, will be the biggest winners in the next cycle. Don't leave the market, but respect it. I am Thien. See you at dawn.